Hello everyone, welcome to our July webinar. I'm going to wait a little while as people filter in, but just to kind of set the scene, I'm Phil Thompson, one of the advisors at Skye, and we've got Matthew Warren, who's another advisor at Skye. Super excited. We've got over 100 people registered. This is Matt's first webinar, so I want to see in the comments if he's doing well and also if he's not doing well. Feel free to let him know any improvements. How are you feeling, Matt?
A little bit nervous, but we'll see how we go.
There's only 100 plus people watching you, so
I'm sure they're all very, very kind people with lots of nice things to say.
We've also both got young kids in the background. So during this webinar, if we hear screaming, fantastic. It just means we are human beings and we've got little ones who our partners are looking after. My mother-in-law's here actually because Kate had to go and do a high school session, something. Forget. It was like a information session for our eldest. She's going into high school next year, which is really scary. Have you guys thought about schools yet, Matt?
Katie was looking at like a preschool the other day. It was kind of a Montessori type of place, but she didn't get a good vibe from it. So apparently we're not sending Flora there.
Cool.
So the search continues. But as far as primary schools, no, nothing yet. But I think you're supposed to, aren't you?
It's so crazy. It's crazy. You got to look so far in advance. Like last year, the start of last year, what do we have? We had like grade 5. And my wife's like, no, we need to have been looking for high schools a while ago. I was like, well, she'll be right. Anyway, we got into the one we wanted to. All right, let's get started. One thing to note before we kind of kick off, there is a chat function with this webinar software. So we're going to be doing a lot of time dedicated to Q&A. We'll find the most value people get from these webinars is the Q&As. Ask any questions. The curlier, the better is what I say, because we're going to talk about insurance within your super fund. But I'm really keen to just answer as much questions as possible. Before we really kick off, there's a few things I wanted to touch on. So we do have a poll. I've never done these polls before. Let's hope it works. But the first question is, do you currently have any personal insurance in place? It's a yes or no, really simple answer. We just want to get a gauge of the people who are watching if we've already got insurance in place and we may look at reviewing it. Or you're just here to get some additional information and extra knowledge, or if the people watching have got, no insurance in place. So that's good. We've got a few answers already. So half, which is really good. So I think everyone will get a lot of value out of this if you're considering getting insurance and what that looks like. Now, I do have another question. The next question is if it's really for half of the audience who have already got insurance set up. I'm kind of interested to know where you've got your insurance. So the two, let me just share it now. Yeah, I think that worked. So how did you set up your insurance if you've got it? So the two answers is I went through an advisor or I went straight to the super fund for it. Again, splits, fairly evenly split, which is good. So I think everyone will get value out of this. Insurance is one of those things that's extremely boring. No one really wants to talk about it like they do AFL scores, but it's super important. So before we get started, quick disclaimer, just want to talk about this information in this webinar is general information only. Do not go and action anything off the back of this webinar and say, oh, Phil told me to do this or Matt said this, so it must be right for me. It's all general information, so don't come and sue us and get grumpy with us. If you've got any questions, reach out to us directly. Excuse me. But the agenda. So what we're talking about today. So as I said, we're going to leave a lot of time for Q&A at the end. But the main topics we're going to touch on is, or the topic is insurance within super. But first of all, what is personal insurance? We're just going to touch on just as a quick refresher. What are we talking about when we're talking about personal insurance? The next thing is the insurance in your super fund enough? As we touched on, half the people who've got their insurance within super. Is it actually enough? And what are the major differences between the different types of insurance policies? And then we're going to touch on case studies as well. And then just quickly touch on some myths about life insurance inside super. And then, as I said, Q&A. We're going to spend heaps of time on that. So Matt, handing it over to you, what is personal insurance?
Alrighty. Personal insurance, there's a few different, it's also referred to as life insurance generally. So there's a few different types of policies that fall within that. So the first one we've got is life insurance. So this is also referred to as death cover, or death insurance, but is essentially there to pay a lump sum benefit amount if you die or if you're diagnosed as terminally ill. So generally, terminally ill, you need to be showing that you're going to pass away in sort of 12 to 24 months in order to actually claim on that policy while you're still alive. So why we want that cover can be used for things like replacing income after you pass away to support your family. So if you've got children that rely on your income, or a partner who's not working, so that you've still got some income coming in, then we want to make sure you have a roof over your head without any ongoing rent or mortgage. So look to clear that mortgage on your principal place of residence. And then finally can go towards funeral costs. So, if you want a really bougie funeral, you can add some extra cover to your life insurance, and so that you can get a really good send-off when you do pass away. So the next type of cover, also a lump sum, so TPD, or total and permanent disability insurance. Might refer to as TPD from here on out. It's less of a tongue twister, but it's there to pay a lump sum benefit if you become totally and permanently disabled, or basically if you're never able to work again. So there's a few things we want TPD to do. So the first, replacement of your income. So, pretty much everyone relies on their income and probably relies on most of it. So even if you have income protection that's paying out for the long term, it's not going to replace 100% of your income. So TPD there, you can get a lump sum that tops up the gap between your income protection and what you're currently earning. Then again, if you're never able to work again, you're not getting an income. So we want to make sure, again, you have a roof over your head without any associated costs with that. So no mortgage, no rent. So we look to clear that debt again. And then finally, any sort of illness or injury that means you're never able to work again is probably going to come with some medical costs. So we generally add in an amount to cover those medical costs. So really common question against that is, okay, well, what about private health? What about the public health care system? Not absolutely everything is covered by private health or the government. So could also go towards things like making modifications to your home or vehicle if you've got a physical disability and you need to make those more accessible. Then income protection. So similar to total and permanent disability, pays out if you're unable to work due to an illness or injury. Unlike total and permanent disability, it's not a lump sum. It's actually a monthly benefit that pays out for the length of time that you're unable to work. So really important here, if you're unable to work, we want to make sure your income is still coming in the door. So income protection actually replaces the majority of your income if you can't work. And that's really important just to cover those regular expenses, because a lot of us would be in a little bit of trouble if we stop getting that regular income, because even if you have a savings account, it disappears really quickly. Trauma insurance. So this is another lump sum cover. So it's not like total and permanent disability and income protection in the sense that you need to be unable to work in order to claim on it. It actually pays out a lump sum benefit on the diagnosis or when you suffer a serious illness, such as cancer, heart attack, or stroke. So a couple of things we want to do with or have trauma insurance for. And so we want to, again, cover any medical costs. So, cancer, it's not cheap. There's a white paper from one of the insurers saying the average cost of cancer is about, I think prostate cancer is about $40,000. So those things do come with a cost, and it's not always covered by private health or the public health system. Then short-term loss of income. So Income protection only kicks in after your waiting period, and that waiting period could be as short as 30 days or as long as 6 months or 2 years. So we want some money coming in the door in the interim before that income protection actually starts to kick in. We also want some funds set aside in case your partner needs to take time off work to care for you, or if you need some extra funds to take care of the children. So whether that's you or your partner taking time off work, or even just paying someone to come in and do the school drop-off, or even just being there for the children during the day if they're not quite at school yet. And then speaking of children, the fifth type, and really not very well-known cover, is child's cover insurance. So it's very, very similar to the trauma cover, except instead of protecting you, it protects your child. So if your child, aged generally 2 up to 18 or 21, depending on the policy, if they suffer one of those traumatic illnesses, such as heart attack, cancer, stroke, burns, and sometimes death. So that pays out to, one, protect against any of those unforeseen medical expenses, if you need to take time off work in order to care for the children, or of course pay someone to come in and help you support the children while they're recovering if you can't take, all of your time off work. So there will be, just to get some jargon out of the way, we'll be talking about super fund versus retail insurance today. So the super fund insurance, we might also refer to it as group insurance, but essentially what that is where a trustee of a superannuation fund purchases an insurance policy in order to provide cover for a group of their members. So with the default insured amounts being determined by a formula or a set table. So X age equals X amount of cover at X cost. Then retail insurance. So this is unlike group cover. So you're not lumped in with a whole bunch of other people except for the premiums that go to the company. So this is where you set up an individual policy that's medically underwritten. So basically they look at your medical history and they assess that for any risks. And then, so the terms for that cover can't be altered by the insurer after the initial setup. And this cover is more often than not sourced from or through a financial advisor. All right, Phil, back to you.
All right, cool. I was about to go on for about 5 minutes and just realised I was on mute. So, Eric, you quickly touched on the third option of DIY. So yeah, I understand there's people who may have gone out and sourced their own insurance themselves. We're not going to explain the pros and cons of that in this webinar. Just we're trying to make it as informative in a very simple kind of super versus non-super. But a lot of those direct policies, you either go direct to the to the insurance provider, and you're getting a retail policy, so it's similar to the retail policy we're talking about, or you get a direct cover, which is kind of very watered down in terms of their offering. But there's only 2 insurers on the market who offer a retail cover, but they do go direct. So we're going to talk mainly on the super fund cover. So now, is the cover that you have within your super fund enough? Now, the average Australian, based on the ABS data, is the average income in Australia is $71,500. Now, that includes full-time, part-time, casual workers. So everyone who's gainfully employed, the average is $71,000. If you talk about just full-time workers, it goes up to around $90,000 a year. And then the average debt in Australia, so new loans taken out across Australia, is $585,000. Actually, it's reduced slightly since the peak last year. But in terms of all loans out there, all outstanding home loans, we're talking about just over $350,000 worth of debt. So the average Aussie, let's just say they've got $350K worth of debt, their income is $71,000. And fun fact being that super funds actually insure 15 million Australians. So the cover that they provide is really important in terms of what they provide as a default level of cover, because that is where a lot of people have insurance. Now, in terms of is that default level of cover enough, my view is just based on what the average income and debt of Australians are, the default level of cover based on the top 3 public super funds that we're going to look at today in a few of our case studies, plus Host Plus. Host Plus being one of the more well-known, even if they're not as big from a size point of view. their default level of cover is really small. So Australian Super is the biggest in terms of the size, in terms of funds under management. And so when you look at the default level of death and TBD cover, so the TBD cover caps out at, what is that, $61,000 is the most disability cover that you'll get on it as default. And when I say default, means you join the super fund and they give that to you automatically without going through medical questions or anything like that. Now, you can apply for extra cover for the super fund, and so you can always increase these numbers, but this is the default level of cover. So life insurance, in terms of the level of life insurance cover, well, it's $183,000, and this is the biggest super fund in Australia. And you know, as a 25-year-old, it's quite low, and then it peaks out at 34 years old, or no, 33 years old is the 31 years old. No, 30 years old. Oh my goodness, we'll get there. Come on, team. So 30 years old is the peak, which is actually not the peak debt of Australians. The peak debt is actually closer to late 30s as well. So that's the biggest. When we talk about income protection, they offer default income protection, and that's $3,100 per month. And given the average, debt and income levels, these default levels of cover are really insignificant. And that's the biggest, and they're actually not that bad compared to a lot of others. The next one is Australian Retirement Trust. So, I mean, we're not. I'm not here to call out any super fund. They've got a role to play as super funds, and they do a really great job because they're not actually the insurance providers. So they outsource a lot of their insurance to third-party insurance providers. So Australian Retirement Trust, their default level of cover caps out at $250,000 for life and TPD assist. Then next one is Aware Super, and Aware Super's default cover caps out at $261,000, and then slowly reduces over time. And Host Plus as well, they cap out at that $174,000 worth of cover at 40 years old. Is the highest level of cover, and TBD is even less than that, $145,000 of TBD cover. Now, if we look at those averages and we go at the average debt of $350,000, average income of $71,000, is $145,000 enough and adequate if you could never ever return to work again, which is what TPD is? The answer is just no. The default level of cover across the board is, generally speaking, underinsuring Australians. And again, it's not the super fund's fault. That's actually not their job to be insurance companies. But just when we're looking at that kind of the default level of cover, it's really simple. The answer is no for almost every Australian out there when we're looking at the averages. Unless you got millions of dollars of investable assets, you're sitting on a passive income of $100K a year, maybe you don't need any of the cover, but I'm not in that position, and very, very, very few people are in that position. So next we're going to be talking about what are the key differences. Now there is a lot of nuance when it comes to insurance, and Matt and I can geek out as much as we can. We built this presentation and we just scrapped so much information because we just want to get to some of the key points. So we're not going to talk about every little difference between the policies. We're just going to talk about these key factors. You're right, Matt. What are the major differences?
Alrighty. So, as a quick summary, so the major differences are the options you can get with the insurance. Second of all, the payment flexibility, so where you can actually pay that from. And then, can the policy change after you've received or have noticed how much cover you actually have? And then the fourth is cost. So we'll go through those now. So first off, with the group insurance, generally how that comes along is you start off, or you join a super fund. Either you've chosen that super fund or you've been lumped into that super fund from an employer. And if there is default cover within that super fund, that's who the insurer is. So there's an insurer that basically sits in the background and offers all of the cover for the members of that super fund based on their age and income, etc., etc. But there's only one. So if they don't like something about your situation and you try to increase that cover, then you might be out of luck because they may say, no, we don't want to accept this risk. And then you're stuck with those default levels of cover that you've already been given. Whereas on the retail side, you can actually, there's 10 or more insurers available. So you can actually do what's called a pre-assessment. So you reach out to each of them, provide some really basic information about your medical history and your occupation, and go, okay, which one of you is actually going to give me the best offer? And you can pick and choose as you prefer. You can also weigh up each of them on cost. So you don't necessarily have to go with the cheapest or the most expensive. You have that choice before you make any applications. But with the group, once you apply, if they decline, they decline. Your only other option is to then try and find another super fund that's going to have a different insurer in the background. So then payment flexibility. So again, generally those insurances are lumped with the super fund. So if you're with super fund A, you're going to be paying for insurance through that background insurer. If you then want to move to super fund B, either that super fund B is going to have to accept that transfer of insurance from super fund A, or you lose the insurance from super fund A and you get new insurance through super fund B. If that's something you've done manually, you may actually not be able to get those default covers, or you may have to specifically opt in, which may trigger some underwriting. Could be minor underwriting, could be full underwriting. Really depends on each fund. Whereas on the retail side, you've got your insurance set up. They're their own policies. The extent that your superannuation gets involved is that's where the money can sometimes come from once per year. So if you're paying for your insurance each year from super fund A, you eventually get sick of them and you want to move to super fund B, it's really easy to move. So you don't have to then cancel that insurance and then reapply somewhere else. You can just take it with you. So all you've got to then tell the insurer is, hey, I'm now at super fund B. It's one form. And then from then on, you'll pay your insurance through super fund B and nothing else changes with your policy. So a lot more flexibility there with the payment. Then can the policy change? So often a concern with the group insurance is that it's at the super fund's discretion whether they change that cover. So a whole range of factors can change, but we've just got an example here from one of the insurers where basically they just sent out a form that said, hey, here's some changes we're going to make. So they were replacing the structure of their insurance from the very basis of how they actually calculate it. So previously you'd get a number of units. Each of those units would be worth a certain amount, and they're replacing that with an age-based cover design. So purely based on your age, that's how much cover you get. So similar to some of those other tables Phil was just talking about. One of the not so good changes that came along with that is they have now changed their terms so that if you are claiming on your income protection for the short, medium, or the long term, and then you satisfy a TPD claim, even if you have a long-term benefit option for your income protection, as soon as you get that TPD claim approved, they will stop paying your income protection, which is not going to be a great place to be in if you were relying on both, the income protection for the long term, as well as that lump sum from TPD to kind of top up the income protection. So whereas the retail side of things, once it is in force, they cannot change it unless you make that request to them. So if you want to decrease your cover, you can do so. If you want to increase, that's more of a risk to the insurer. So they may ask some additional questions. You may very likely pay a little bit more if you increase your cover, but only if you start that request. They can't just decide that they're going to make changes to the policy or the terms. Now, so we've got a little blurb there. So guaranteed renewable. That's a pretty funky term, but essentially, as you can see in that little box there, they're saying that they guarantee to renew that plan each year until the plan expires, provided you keep paying those premiums when they're due. So your cover can't be cancelled, can't have further restrictions placed on it, and the premium can't be increased because of changes to your health, your occupation, or your pastimes. So, as you can imagine, if I'm an office worker, I might get pretty good premiums. If I then decide to be a skydiving instructor, insurers either may not insure me or they may charge a lot to cover for that risk. But if I have taken out my insurance while I'm an office worker and then decide to become a skydiving instructor, they can't then decide, no, we've got to charge Matt more now because he's a high risk. And in terms of cost, we'd love to give you a definite answer on which one's going to be cheaper, but it is complicated. But we will talk more on that soon because we've done a heap of research to prepare for this webinar to hopefully provide some value and actually, something to look at or think about. So while it's complicated, we do have some interesting info to look at.
Yeah. So, I mean, just to touch on there's a few major points that I want to drive home today. One is cost, which I'm going to talk about now. But the other one is the fact that the policy can change on you. So the goalposts can move over time. Like, I don't know if we kind of explained it well enough, but income protection is a monthly payment that gets paid until your benefit period ends. So you can get paid out every single month until you turn age 65 if you can never work again. Disability or TPD is a once-off payment. Now, Aware Super, and I'll call them out pretty harshly, Aware Super changed their policy where in the past they paid both of them together. If you could never work again, we'll pay you a monthly benefit until age 65, plus we'll pay you a TPD payment as a lump sum. And then they just completely changed that policy where they will just stop that income protection payment. As soon as you're eligible and you make a claim for TPD, great, we give you your $250,000 and we stop paying you your income protection. So that is really significant. And actually one of the biggest differences between retail and group cover is the insurance provider, Aware Super, they're incentivized to reduce premiums for their members, which sounds great. How good, they're not, eroding my super balance. However, the issue is that they'll potentially make some compromises, or they did make compromises on the policy that if I was insured by them as a member, I would be really unhappy if I ever needed to claim on it. So when we talk about the policy changing or the ability not to change, it sounds like, oh, well, that's great. The policy can never change, but you're not going to get these really, really poor outcomes at claim time because of those policy differences. So I'll move on from some of those nuances. But the other big myth that we do see is premiums. I see it on Facebook all the time. When anyone reaches out and says, where should I get insurance? Everyone says, go to your super fund. Barefoot Investor says the best way to get insurance is through your super fund. And the idea that a super fund, they're controlling millions of members' insurance policies. So theoretically, they can go to an insurance company and say, hey, we're going to give you 1 million policyholders. Give us a really good price on it. And theoretically, it makes a lot of sense that they would have that buying power to make the premiums cheaper. But in reality, it's just not the case a lot of the time. So we selected the top 3 public super funds to give a premium comparison on, plus Host Plus, because Host Plus is probably one of the more famous super funds promoted by Barefoot Investor. So a lot of DIY people are really keen on Host Plus, which their investment options are, I can't say anything about it because I'm an advisor. I'm not going to tell you if they're good or bad, but that's why we chose Host Plus. So I personally am extremely skeptical. Anytime I listen to anyone, I call BS all the time. So I always have a skeptical hat. So I wanted to touch on our recommendations over the last quarter for our business, because we're financial advisors. We help people set up insurance. And so that's kind of what we do. But And I would come to this webinar thinking, well, they're just trying to get us to set up insurance for us so they can get paid a commission and happy days. But in reality, most of our clients, we recommend they maintain their insurance policies where it is. So we did 154 recommendations. 78 of our clients, we told them to keep their existing cover where it is. For whatever reason, a whole bunch of reasons why we told them to keep their cover where it is. And 40 of our clients, we told them to replace their cover. And every time we replace cover, as advisors, we legally have to provide what's called a comparison. So is your existing provider good enough that we can just increase the cover with and you can still be insured by the same provider? And out of those 40, there was what was it? It was 11, I think 11 people where it was slightly more expensive to go with the alternative provider. Now, there's plenty of reasons why we recommend spending more money on insurance than the existing provider. But majority of those clients, like 80% of our clients who we recommend replacing their cover, when we do those comparison reports, it's 80% of the time it's cheaper to go with the retail provider. So yeah, we're not in business just to move policies, and a lot of those clients who we recommend retaining their cover, as I said, there's a lot of reasons for it, and we don't just say your cover's good and happy days, see you later. We say we keep that in place, and we'll take out other cover as well to cover that gap. So yeah, we're not in the business just to move policies, but it really does. I mean, I get really grumpy sometimes. I'm getting older, I'm more grumpier, but it makes me really grumpy when people say just go straight to a super fund to get your insurance. Now, as I said, we're going to show a case study of those 4 super funds. So Australian Super, their insurance provider is TAL, T-A-L. And if you go to Australian Super, we've got examples, different ages, different sexes, different occupations, different income. So we're trying to give you a good broad breadth of it. We're not cherry picking professionals or blue collar workers to get the numbers we want. So this client is female, 36, radiographer, $80,000 worth of income. So the default level of cover with Australian Super costs $275 per year. But if you go to TAL through a financial advisor, you're going to pay $463 for similar kind of products, the same level of cover, similar kind of definitions. But if you want to go and increase that cover and you want to take out $1 million of life, TBD, and income protection policy till age 65, Australian Super, or TAL, really increase the premium significantly, 1,000% increase on premiums. When TAL directly through a financial advisor is going to charge you $1,621 per year. So it's a 350% increase in that cost from that base level to that high cost. So using TAL through a financial advisor is 41% cheaper than taking out that same level of cover through Australian Super. Now the next example is a male, 46, personal assistant, 95k of salary. Australian Retirement Trust is the next super fund. So their underlying insurance provider is AIA. AIA, if you went for their default, AIA is actually cheaper going through an advisor, even just on the basic default level of cover. And then if you want to increase it, again, $1 million of life and TPD, and you want income protection, 70% of income protection, 30-day waiting period till age 65, it's $4,200 a year through Australian Retirement Trust, when it's $3,300 through an advisor going with AIA. And one thing to note, when we did this premium comparison, AIA wasn't the cheapest offering out there. So there was cheaper insurance providers, but we wanted to show a comparison of going, it's the same insurance provider. It's actually, in fact, better products through the advisor than the insurance provider, and it's cheaper through the advisor, and the advisor gets paid a commission. So this idea that commissions are boosting up premiums, or this idea that the super funds are the best way to go, for a lot of people, for 80% of the times we move policies, it's cheaper to go to the retail provider. And so 22% cheaper and 16% cheaper on both of those options. Next example, I've got 2 more to go, and I'll keep ranting as I'm going through these next 2. But stick with me. We've got a female, 43 years old, an OT on 110k a year with Aware Super. So Aware has TAL as their underlying insurance provider, and again, Aware's that provider who just made those changes. So you can't actually get paid a TBD and an income protection at the same time. You get one or the other. But if you did want to have a policy with Aware Super, income protection till age 65, and TBD and life insurance, then again, it's cheaper with TAL going through a financial advisor, 4% cheaper, but on the default, it's heaps cheaper. The last example is what have we got? Host Plus. Again, the reason we picked Host Plus, they're the 10th biggest super fund in Australia, but the reason we chose them, Barefoot Investor promotes Host Plus as a cheap provider for super, and so we just want to look at, okay, what's their insurance like, because they've got a different underlying insurer as well. So their underlying insurer is MetLife. If you go to Host Plus on their default cover, it's slightly cheaper than going through an advisor on that level of cover. But when you increase it, and the reason we increased it to $1.5 million is because Barefoot Investor says cover 10 times your income or 12 times your income. So this accountant, 30-year-old male accountant on 150K a year, doing well for himself, mind you, I would be nice. But he's gone, read Barefoot Investor, said, yeah, I'll cover 10 times my income, 1.5 mil. We don't subscribe to that way of thinking, but we just did it for an example. And again, going through MetLife through a financial advisor is $2,000 a year for versus $2,500 going through Host Plus. So now it's not always cheaper. There are plenty of examples where it is cheaper with the super fund, but it's less common than getting it cheaper through a financial advisor. And again, this client, this hypothetical person, MetLife wasn't even the cheapest underlying, or it wasn't the cheapest insurance option out there. So there were plenty of other insurance options who were cheaper than that. So when you compare the super fund insurance versus everything else on the market, a lot of the time, 80% of the time, we see it is cheaper to go through a financial advisor than to go through the insurance option within the super fund. So common misconceptions. Now, we are going to go through some myths and we're going to hit up a Q&A. So get your questions ready to go. I can see there's already some ready. But get some questions ready because, we just want to try and provide as much value as we can in this session. So go, Matt.
Alrighty. Myth number 1. So the only way to pay for premiums via super is to apply directly with that fund. So, people typically think, I want all my cover via super so I don't have to pay out of pocket. I've got to then apply for the insurance within my super fund. It's just not the case. So as we pointed out earlier, if you apply for retail cover, doesn't matter where you're holding that or which insurer that's actually with, you can choose the super fund that you want to pay it from. And then if you do move super funds in the future, you can absolutely do that. Myth number 2. If I move super funds, I'll lose my insurance. So with group cover, in some cases, you may not be able to transfer that cover. You may not be able to get new default cover with the new fund, but in most cases, or in some cases, you'll be able to apply to the new super fund to take on the existing insurance that you've got in that first super fund. There may be a couple of questions around that, but at the end of the day, if you still get a similar level of cover and it's relatively the same cost, then it's a good way to do it if you don't want to go through full underwriting. But if you do have retail cover, then as we mentioned again earlier, doesn't matter what you do with your super fund, provided you still have one. You can just tell the insurer that you want to then pay for those premiums from this new super fund. So with retail cover, changing super funds is not a concern when it comes to your insurance, because all you have to do is submit one form and then you pay from the new super fund. Nice and easy, done. Myth number 3. So the cover I can see in my super fund will remain the same. So I've seen some horrible stories where people have gone, cool, I've been given default cover of 300,000, life and TPD, awesome. If anything happens, I'll get 300,000. They don't ever check it again because they think that's what it is, that's what it's going to stay as. And then they try and claim a couple of years later, 10 years later, and they realize that it's age-based cover. And over the years, it's slowly been decreasing. When they actually go to claim, thinking they're going to get the 300,000, there's about 50,000 left in that super fund. So that's a really important thing to look out for with group cover. Just that it can change. So if you do have group cover, you are hanging on to it, just keep your eye on it because it can change. So retail cover doesn't go down unless you request that it goes down, but it might actually increase each year. So there's a benefit that comes with most policies or can be added on. It's called indexation. And essentially that's there because, as we've all seen recently, cost of everything is rising and rising really fast. We want to make sure if we're only claiming in 10, 15, 20 years time, that the $1 million we took out 20 years ago still buys us the same thing that we planned for it to do 20 years ago. So indexation, your policies will keep increasing slightly, or of course you can increase that cover, but you don't have to worry that it's going to go down without your knowledge. And then the fourth myth is that the super fund cover will always be cheaper than retail insurance or cover through an advisor. So as you hopefully saw through those examples that Phil looked at recently, those were just a couple, but like we pointed out, 80% of our clients, when we are replacing cover, we can see that increasing those levels of cover to the amount that clients actually need through the super fund often comes out more expensive than if they went direct to a retail insurer, which also includes that commission. So it's not like commission then blows it out of the water. Conclusion. So,
Skye, you
Phil,
going to conclude this?
Okay. All right, I'll close this off. So we just want to reiterate, group insurance is not a waste of money. We do not want anyone to just run out after listening to us and cancelling all their cover, thinking that it's crap. It's not. It's really important. If you haven't then looked at your cover before, and can also serve as a really valuable backup in case you do apply for new cover and you get a medical or occupational exclusion. So as Phil said, nearly 50% of our clients, we actually recommended they hang on to their existing group cover because it served as a really good backup. So group insurance isn't always cheaper. We had a couple of examples. In some cases it is. That's brilliant. But yeah, when you've got the benefits of going retail, looking at the different insurers, what terms they're actually going to offer, there's a high likelihood it's going to cost you less, and you've got the support of a professional. We're insurance nerds. We do this all day, every day. So why not just, ask us instead of having to do all that research yourself? So not all policies are created equal. So it'd be fantastic if every TPD policy had the exact same definition, exact same payment amounts, etc., so that you could go, cool, I have TPD, I'm going to be okay in the event of XYZ. But unfortunately, that's not the case. So you need to be really, really confident in the cover that you have, and that those definitions and the policies you actually have are quality, or at least, provide value for the amount you're paying for them. So knowing exactly what you are and are not covered for, carrying on from that point is really, really important. So I can't imagine a worse outcome than thinking you have a certain type of cover or protection against certain events, having that event occur, maybe you've lost your income, you've had a trauma event, you don't have trauma insurance, and then finding out you're actually not going to get paid because either, in the example of a trauma event, maybe you don't meet the waiting period for the income protection and it's not a permanent injury or illness. So you also don't go for the TPD payout. So really important to know or ask someone, what are you covered for and what are you not covered for? So also, cover that can't be reduced or changed without your instruction or your knowledge is worth every cent. So even if, we found the majority of retail cover was more expensive than the cover you can get through super, we would still be screaming about it from the rooftops, because at least when you've got a retail policy, you know what you've got. It's not going to disappear, provided you keep paying those premiums. And whereas the group cover, if personally, I would lose a little bit of sleep at night knowing that one day the super fund or the insurer could just say, we're going to change these terms, and then they make a major change, or increase that cost massively, or just get rid of a benefit that you really valued previously. And then the final point we want to drive home is please get professional advice. As we said, we're nerds. We do this all day, every day. So why not just come to us and we'll do the hard work for you. We'll answer any questions you have. So, you can ask anything. There's no silly or annoying questions. And we actually do get excited to answer questions about this because it's what we're passionate about.
I mean, also, Matt's giving us the hard sell. Like, don't come to us. Like, we don't care if people come to us or not. We think it's very valuable to get professional advice when it comes to insurance. I'll just quickly touch on, I think it is really important because we have talked about, hey, insurance inside super. We didn't go into a lot of the details about the inferiorness of the product. Is that a word? Probably not. We didn't talk about how some of the terms and conditions are really poor. We touched on one of the changes that was made, but group insurance isn't a waste of money. As we said, 50% of our clients, we tell them to keep it. And some of the really big key reasons we tell people to keep their existing group cover is because under those default levels of cover, even though they're quite small, and one of the reasons they are quite small in terms of their default level of cover is because it's automatically accepted. Any pre-existing medical condition that you have will still be covered under that policy. So a big reason why we keep existing group covers in place, and it forms part of our clients' kind of overall insurance strategy, is because they've come to us and they've had a pre-existing health issue that we know the new insurance provider are going to exclude. So they're not going to cover that. So we want to make sure, let's say it's a mental health exclusion, but their default cover, $250,000 of aware TPD, will pay out under a mental health condition. So that's why a lot of our recommendations is keep that in place, but then add these other policies in place. So it is really important. Again, I want to reiterate, I don't want anyone to walk away from watching the video replay or watching this live thinking, oh, I've got 164 grand of cover, I'll just go cancel it and then I'll reach out to an advisor later. Definitely get professional advice before making any changes with your insurance policies. I can't stress that enough. Whether it's us or anyone else, couldn't care less. Definitely get professional advice, because insurance it's relatively simple in its nature. Most other insurance policies we just buy online and they are relatively simple. When it comes to life insurance, it's one of those things you almost never ever want to use. But if you do need it, anyone who's ever claimed on it is never thankful that they scrimped out on the policies or the terms or anything like that. So Q&A time. We've got some questions here, but let's go through some of those questions. So Eric asks, for income protection under retail insurance or in general, do we need to keep paying premiums when we're under a claim situation? So it's a really good question. So with income protection, you're either paying premiums or you're getting paid money from the insurance provider. You'll never get both at the same time. So if you go on claim and you're unable to work, the insurance provider will give you money. So you're either giving them money or getting money from them. And so once you go off claim, then so as in you return to work, then you keep paying your premiums again. Really good question. And a lot of people think, well, if I'm on claim for 30 years, do I still need to keep paying these premiums at the same time? No, you don't pay anything. They're paying you money. So it's a good question.
All right, so the next one we've got there is, how do insurance brokers or advisors get paid their fees / incentives? So is it by the insurance providers, similar to a mortgage broker, or by the individual policyholder? So also brilliant question, but yes, you're very much on the nail there. So similar to mortgage brokers who get paid by the bank, any commissions we do get paid is paid by the insurer and not by you directly. So that is mandated across the board. No one insurer can pay us more than another. So we're also not influenced to maybe go with one particular insurer that we really like because they pay us a little bit more. It's exactly the same for all those retail insurers.
Yeah, and I mean, gone are the days that with brokers and with advisors, gone are the days where the banks or the insurance providers flew you around, on holidays. Like, you can't get any incentives. We're capped out at $300 in terms of gifts from every insurance company annually. So we can't even get bottles of wine that collectively cost over $300. We've got to log every gift we get. If we get a notebook, the insurance provider sends us an invoice for it. We don't pay for it, but they send us the cost of it so we can put it in our register. So it's called a soft dollar register. So yeah, gone are the days where we're just going to write AMP because they own our licensee. It is much more kind of simpler in terms of its nature. It's very much similar to mortgage brokers, where they can look at the market, recommend a product that's right for you, and we get paid similar amounts. So Danny's got a question. Is it true that you cannot have trauma insurance through your super fund? Exactly right. So that's one of the other things that we didn't want to overload people with too much information about pros and cons, because our key message is it's not one's he's better than the other. Well, I think one's better than the other, but it's not like a super is bad. But one of the things that is not great about super insurance is you just can't have trauma insurance. Matt touched on it earlier, but trauma insurance is things like cancers, heart attacks, strokes, MS, Parkinson's. Like there's 35 plus odd conditions depending on the policy and a whole bunch of other things. But there's a lot of conditions. Most of those claims are for cancer, and like I'm sure we all know someone who's had cancer before the age of 65, because it's extremely prevalent. My sister-in-law had it. One of my really good friends is going through chemo currently. So trauma is extremely important, and it is a very, very important part of your overall insurance needs. And that is another deficiency with superannuation. They can't offer it because you can't pay for trauma through your super fund. So the super fund just ignores it and pretends it's not a thing.
Alrighty, and then the last question that we have, or at least I can see, is from Manisha. So that is, how do we know what type of life insurance that we need? So especially when you're in your 20s, like me, and don't have a partner or family for now. So really good question. There's a lot of calculators out there that might be able to help you, but any decent advisor is going to help you with that. So they'll ask you lots of questions about just your overall situation, more specifically your financial situation. They'll ask about your goals, and based on that, they'll be able to provide some recommendations. So they should actually be able to break it down and say, we've recommended X amount, and for life, activity, trauma, income protection, and this is a breakdown of how we actually calculated that. So one thing we do here is break it down. So instead of just giving you a final figure of how much insurance we think you need, we break it down into each section. This is how much we think you need for this. This is how much we think you need for this. And so you can actually go through it with us and go, actually, I don't value that, or maybe, that's not enough. Can I get a little bit more? So definitely something that an advisor can help you with.
But also to answer the question, if you're in your 20s, a lot of people say, I'm in my 20s, I'm young, healthy, don't need insurance. If you have an income and you rely on that income, or you have financial goals that your income is reliant on meeting those financial goals, you 100% need income protection. Even though the likelihood of a claim is much lower, the cost of that claim is significant in terms of if you could never work again as a 20-year-old, financially completely stuffed. Like that's the technical term for it. There's no other word for it. Financially ruined if you could never work again. So income protection is a must. Trauma insurance and disability are really important as well. Even though, again, it's less likely to happen, the financial severity of any of those matters is really significant. And also, because it's less likely to happen, statistically, the cost is much lower while you're younger. I ran for 3.5 hours as to why young people should get insurance, because it's super important, because you're doing it before any major medical events, potentially. As an older person of a vintage of 37 years old, 36? I don't know how old I am. 36, I think. You get sorer. There's more pains and aches these days. So when you're younger, you're definitely much more less likely to get exclusions. So I'll keep ranting. All right, let's go. Who's next? Bianca. Just a PSA for anyone listening. My life and TBD insurance is through my super fund at Australian Retirement Trust. By default, they set their members up as blue collar. If you complete a form to nominate yourself as white collar, they will double your payout amounts without increasing your premiums or charging any additional fees. Yeah, there's a whole bunch of other things that super funds have done in the past with as a default. In the past, they've set people up as a default as smokers rates, which is really nice to double everyone's premium when statistically much less than very few people smoke these days. But yeah, there are plenty of reasons why just reaching out and paying an advisor a fee. We charge $330 for individual, $495 for couples, and some of these things you can DIY some of these things and do a lot of reading and learning, but some of these are kind of pay themselves back, very, very quickly.
So Kim's question, how do we know how much cover we need? Probably a very, very similar answer to Manisha's question. You can try and figure it out yourself, but unless you are doing this all day, every day, it's probably just easier to chat to someone who does. So again, if you don't want to speak to an advisor, there are calculators out there, but you may not, or they may not include things that you don't even think about. So we don't know what we don't know. So it is good to have someone where you can bounce ideas off, or they can say, this is what we think. And then you take the reins from there and say, actually, I do value this. I don't value this. Can we bring that cover up or down depending on those answers?
Yeah, but on a high level, Matt, how do we think about the level of cover at Skye?
Well, we don't want to go nuts, because the more cover you take out, the more premiums you're likely to pay. So really, income protection, we want to protect as much as possible. So generally, unless someone has huge amounts of income and they only need $5,000 a month, we're going to aim to protect that 70% that they can get for income protection. In terms of the life or the lump sum covers, so life, TPD, and trauma, it goes back to what we touched on right at the beginning. So what is the need for those covers? So if you pass away, we want to make sure that our partners and family are looked after. So if you have anyone relying on your income, you can replace your income for a number of years. You can pay off the mortgage on your house so that your family still has a place to live with no ongoing payments. And then, of course, you can include some funeral expenses there. So TPD, again, replacing your income. So anything that's not covered by income protection. So you do have as close to 100% of your income covered for the long term if you're never able to work again. Again, paying off that mortgage, or buying a property if you don't already have a mortgage. Really important. I think taking the stress of paying for a roof over your head when you're not able to work is massive. So having either paying off your mortgage or purchasing a property with insurance proceeds, really important. Probably one of the bigger ones. And medical costs. So medical costs also flows onto trauma insurance. We don't know what that event is going to be, but we want to be protected in the majority of cases. So that's why we've got, an average amount for medical costs that comes along. And then with trauma as well.
No, I was just going to say, a lot of our work is we ask clients questions. Hey, what's important to you? If you were disabled and you don't currently have a mortgage, do you want to buy a house? Because at the end of the day, I don't pay anyone's premiums. Neither do you, Matt. I don't know if you've ever paid any clients' premiums yet, but we don't pay anyone's premiums. So it's always a push and pull when it comes to the level of cover. So it is hard to answer exactly how much. But yeah, with trauma, what we were going to kind of mention is things like covering the difference between income protection and your income, because there is always a gap there. And then, covering some medical costs for trauma cover. And if you do have a partner, maybe covering some of their income as well, because they may have a need to take time off work, because it is significant especially cancer. Cancer is the most claimed on trauma event, and it can be really significant impact on the household if that happens. So Anna has got a question. So with trauma and income protection, if you make a claim, then you return to work, does the policy restart, or was as it was, or cancel, or are the conditions changed? So they're different policies. So I'll kind of answer it in two answers. Income protection is one way, trauma is another. So income protection, the policy doesn't change at all with a retail provider. So one's set up through an advisor. The policy won't change. So you go on claim, you're injured, you get paid money from the insurance provider on a monthly benefit until you return to work. Once you go back to work, you start paying your premiums again. Now, the insurance provider, as we there was a section talking about guaranteed renewable, they can't change the premiums on you based on your claims experience. So if you go on claim for 5 years and then you're back at work, your premiums aren't going to change because of it. They may change because you've gotten older, but they're not going to charge you more because it's not like car insurance where you have 5 car crashes and they just jack up the premiums. That's not how income protection works. Trauma insurance is a little bit different, and it's very much important to reach out to your advisor to ask them how the policy works, because there are some options. One option is you use your trauma payment, get paid out whatever figure you're covered for, and then your trauma policy goes away. So if you have another trauma event, you don't get paid out. There is an option that we find important at Skye and we recommend to clients, which is called trauma reinstatement, which means if you get paid a trauma claim, I get my whatever, 100,000, 200,000, 500,000, however much you need, you get paid out a claim, and then you can reinstate that policy after 12 months, and you can make a second claim on that policy if you need to, if you have a separate trauma event. So if you have cancer and then you have a second cancer, you won't get paid out twice. But if you have a cancer and then heart attack, you can get paid out twice. So the trauma is a little bit nuanced, but basic answer is income protection. You go on and off claim as much as you want, as you need.
Justin's question: can I retain my insurance despite having an inactive super fund? That's a very technical question there. The answer is yes, but you need to be really careful. So there is legislation that came out a couple of years ago where if your super fund becomes inactive for, it's generally 16 months or more, some super funds have taken it upon themselves to actually shorten that. So we always say look out for at least 12 months or more, because there is one super fund I know of that does 13 months and then they cancel your insurance. So essentially, inactive super fund means you're not logging in and changing your investments and you're not getting contributions. So that might be for someone who maybe's gone on mat leave or has taken a year off to travel. You're not going to keep getting those contributions to super. And so after 12 to 16 months, that's going to become an inactive super fund. And then that super fund will try and reach out to you, but if they can't get a hold of you and you haven't opted into your cover, then they can cancel that cover. So when I say opt-in, very easy to do. You reach out to your super fund, and each super fund will be a little bit different. And so you've got to tell them, I want to opt into my insurance. And so that might be, they might accept that over the phone. You might need to send them an email. You might need to sign a form. And that just means that even if you start making contributions to that super fund, as long as you're paying those ongoing premiums, they cannot then just cancel that cover unless you tell them to. So really good question, really important thing to look out for if you are planning on taking some extended leave and you are worried that your super fund might become inactive. So yeah, reach out to your super fund and make sure you've opted into your cover.
All right, next question is from Katie. Can you hold both retail and super insurances and claim on both of them? Great question. Yes, you can hold them both. And you can claim on them both. So when you apply for cover, most of the time you'll be asked, do you have any insurance anywhere else? Just to make sure that the total level of insurance isn't like $5 million or $10 million. But generally speaking, for most average Australians, the level that you have can be claimed on for both. Now, big asterisks, the cover within your super insurance, especially the income protection, there are sometimes the terms and conditions that says if you get paid any other income anywhere else, we won't pay you a claim, as long as it's up to the level that we're going to pay. So, one super provider has, gives you income protection worth $2,000 a month, and you've got your own workers' compensation, or you've got your own income protection policy elsewhere to cover your full income. That super insurance will say, well, you're going to get paid that income protection, so we're not going to pay you our income protection. So life insurance, that's really easy. They'll both pay out. TPD, generally, they'll both pay out. Income protection is the only one you just definitely need to reach out to an advisor or even to your super fund and ask them, hey, I've got these. If I claimed, would you both pay out?
Alrighty, next question from Bianca. So, with income protection in relation to the 30-day waiting period away from work, can this period be taken as sick leave, or do they only consider 30 days without any income whatsoever? Really good question. It depends. So, each policy is a little bit different. Generally, with the sort of super fund insurances that you can get, they will look to wait or reduce any payments by the amount that you receive as workers' compensation, or any other income protection benefits like Phil was talking about. And they may also say that your waiting period only starts once you've exhausted your sick leave, and some other benefits may just pay out regardless of whether you've exhausted all your sick leave yet or not. So it does depend on your particular policy, who the underlying insurer is, and if you've got, just depends on the particular insurer.
Yeah, and some insurance providers will force you to use up all your sick leave. So even though you've got a 30-day waiting period, but you've got sick leave for 120 days, they may, within the policy, have a requirement that you've got to exhaust all that sick leave before they'll start paying you. Again, it's really important. I mean, these things are so boring. You got to read through like 100-page PDS. But one of the things you want to look out for, if you are interested in your own policies that you've got, is go to the section where in income protection, where it says when will we pay out, or how will we pay out a claim. And that's really kind of the most important thing, is how do they pay out a claim. And they'll normally have all of those kind of conditions that is in the fine print. But that's probably the section of the product disclosure statement that we, as advisors, we always go there first when a client's got an existing policy. We always want to read, are there any restrictions on this policy? I was looking at one today with one of the other advisors in the team, because there was an income protection policy provided by the union, by Victorian Ambulance Union, and we wanted to make sure, okay, does their terms and condition, are there any catches? Are there any funky clauses in there that means our client, if they need to claim on this, they're just going to be left with nothing? So we just wanted to read through the PDS, read through the terms and conditions, and as our team, all we do is we go straight to the income protection. We go, how do we pay out a claim? And then we read through that, however many pages it is. It's normally pretty short. Louise, I paid off my mortgage and I don't have any consumer debt, so I cancelled my life insurance a few years ago. My children are all financially independent now. Should I consider taking out income protection insurance? I don't need a lump sum payout anymore, as I have an emergency fund. The answer, I mean, I'm not going to give you an exact answer, but it depends, is the real answer. A bit more nuanced answer is like, if you don't have any, if you were to pass away and no one's financially dependent on you, do you need life insurance? Probably not. If you were to never be able to work again, would you want a income stream still? Like, do you need your income replaced, or could you stop work today and be financially fine? If the answer to that question is no, I wouldn't be fine retiring tomorrow or today, then you probably want to definitely consider income protection, because your income, everyone's income, is their most important asset. And so, if you're financially independent, you could literally turn off work, but you're just doing it for fun, or, just for whatever reason, you're working still, then, well, you don't need to protect that income, because financially you don't actually need it. But, there is plenty of people who are financially independent, working as a choice, and they know if they have a traumatic event, like, cancer, heart attack, they still pay for their trauma insurance, because they don't want their financial situation to be diminished because of those events. So they pay that premium. And so that, I have crazy amount of insurance for myself, way more than we insure for our clients, because I just know I'm more comfortable paying those premiums on an annual basis or a monthly basis, because I don't want my financial trajectory, my personal wealth and my growth and where I want to see myself personally go, I don't want that to be diminished if something happened to me or my wife or my kids. So we pay our premiums. Now we need to, because I'm not independently wealthy. But the answer is, if there's no need for income, no financial dependence on you, then maybe you don't need any insurance. But not a lot of people are in that position. Oh, you're on mute, Matt. Uh-oh, someone hasn't used Zoomed enough.
Thank you. I would have just kept going. So last question from Neve. So can you get income protection when you're not on a permanent contract at work? Yes. So there are generally some minimum hours that you need to complete each week. So, on average. So the minimum, absolute minimum is about 15 hours. Kind of better to be on about 20 hours or more. On average per week, that's when you can actually get income protection insurance. In terms of the contract itself, if it is like a rolling contract for 6 months at a time, the insurer might just look at, okay, well, has this been renewed multiple times? Has it been like is there a history of you still working? So it's so similar goes for casual contracts. Do you have more to add?
Yeah, I was just going to touch on the fact that that's Matt talks about, it's better to be on 20 hours. Like, the reason why it's better to be on 20 hours is because it allows us to go to more insurers as options. So there's only like really one or two insurers who will offer income protection when you're working less than 20 hours a week. So it means that we're kind of stuck with those two. If they accept us, happy days. If they don't, they don't. But being above 20 hours means that we've got, choice of insurers. And again, that's kind of what the value is from an advisor is we've got access to insurance providers that the general public don't, because that's just the way insurance is set up in Australia. And it means we can shop it around. We know their policies. Okay, do permanent contracts worker on these conditions? We ask you a million questions up front. We have like way too many, but we have to. And it means that we go and we know, okay, who's going to offer cover. And half of the insurers will come back and say, we don't want to touch anyone who's on a contract. But there are insurers who will offer cover. So they may not be the cheapest on the market. They may not be the insurer who your super fund's going through. But there's an option for us to get cover in place. So a lot of people think income protection applications are similar to banks and lending, because lending can be difficult on contracts, but they are very different. But the goalposts are moving. So income protection 3 years ago, anyone, permanent contracts, really easy, no worries at all. These days, actually much harder to get cover, but there are still insurers out there who will offer cover. All right, that's it for all the questions, I think. So thank you everyone for coming. Really appreciate it. We've got a few last things. If you do need help with insurance, now this is our business, Skye Wealth. We help people get insurance in place. We're financial advisors. That's why Matt kind of chuckled a little when someone said broker, because financial advisors get very precious being called insurance brokers. I'm fine with it, but other advisors get precious. So this is what we do. We help people get insurance in place. And really what we do and what we're passionate about is just helping people get educated on insurance and empower them to make a choice that's right for them. I never pay anyone's insurance premiums. We don't come across and judge anyone for reducing the cover or saving on premiums. Our job is to be that middle person and go, hey, how much cover do you want and do we believe you need? And we'll make a recommendation. And then we do a lot of research on which insurance provider we think is going to be the most appropriate. And then we empower people to make their own choice. And plenty of people say that they don't want to go ahead with the insurance recommendation, and that's totally fine. So if you do need help, feel free to reach out and get in touch with us. And the last thing, and more important than reaching out to us to get insurance, is respond to our survey. We've got a survey at the end of this. We love feedback, positive or negative. We love feedback on these. We're trying to do webinars kind of on every second month, every month. So we are trying to provide as much valuable content as possible. So any feedback is really helpful. We really do. We spend an hour meeting reviewing the feedback that we get every time we do a webinar. So love your feedback. As soon as you leave this, you'll be redirected. Maybe, I think that's what I've been told. But well done, Matt. You did a great job.
Thank you.
And yeah, thank you everyone for coming and really appreciate it.